Well, welcome to the continuation of Investment Fundamentals Week, happening all this week on propertytribes.com with my co-host Graham Rowan, who is the chairman of Elite Investor Club. And right now we've reached day 4, haven't we, Graham? And you're going to talk about the wealth pyramid. Now, what is a wealth pyramid?
You may well ask. It's a thing I've come up with to try and give people a little bit of structure to how they build their wealth. Because, I mentioned how people are a bit random about it sometimes. So there's all sorts of different assets out there. And I know we're going out on a property platform, so people have very much got that in their heads. But there's all sorts of different things that do a different job for you in your wealth. So what I've tried to do with the wealth pyramid is to show that there's different layers, each of which have a different purpose. And then I want to just talk about the kind of assets that we hold in each layer of the pyramid. So shall I get my
you get your drawing. Yep.
Here we go.
So there are
very simple Egyptian pyramid.
Yep.
And then let's do 3 lines in it because we've got 4 layers in the pyramid, and we start down here with what I call the bedrock layer.
Right. Now that is obviously the foundations. Foundations of anything have to be strong. What is that layer all about?
What this is all about is protecting you from something that many of the younger viewers won't even be aware of, called inflation. Okay. And if you go back to, say, the 1970s, inflation was often in the 20-25% a year range. My parents bought a house up in the northeast of England for, I think, £5,000 in 1971 and sold it for £10,000 in 1973. So, even in today's crazy market, you wouldn't see prices double in less than 2 years, but that's what it was like then. My first mortgage in late 70s, early 80s was about 14%. So, this can happen. It's happened before. It tends to go in cycles. So we have to assume that these very low rates of interest and inflation are not going to survive forever. So the bedrock layer is there to protect your purchasing power long term. And this is things that will hold their value for many years, even for generations. So
what kind of assets are you going to pop in there then?
Well, one example would actually be gold bullion. So, gold's had a 5,000-year track record of holding its value. They often say that an ounce of gold in Roman times would have bought a centurion's toga. Today, it'll buy you a Savile Row suit. So if you compare that to the paper currency we're all used to, there's nothing behind sterling. Although the Queen says, I promise to pay you on demand, she's lying. I'm sorry, but the Queen is lying to us. You're not going to get £20 of sterling silver for that little piece of paper. We used to be on a gold standard. We no longer are. So gold gives you some real value and protection for the long term. Now, I'm not a speculator on the gold price. I don't care how many worthless pounds or dollars it needs to buy an ounce of gold today. All I know is that gold, can hold its value long term. So gold would be in there. Funnily enough, even something like fine art would be in there. Art, you can get Picassos and stuff like that hold their value for many years now. Now, it's a specialist area. We actually have an art investment club within Elite that we do this. But if you know what you're doing, you can buy works of art from as little as £5,000 or £10,000 that can become kind of family heirlooms that you pass on through the generations. So I would put that in here. I'd probably put your main home in here. Okay. Now, we've all read Rich Dad, Poor Dad. We know that your house is a liability, not an asset, and so on. But if you take a long-term view, usually people do generate quite a bit of equity and wealth in their home. You don't, at the moment, pre-Corbyn, pay capital gains tax on it. So you've got something to play with there. So I definitely put your main home in the bedrock layer as well. I would put your cash reserves in here. You've got to decide how much cash you need to be comfortable. It might be 3 months living expenses, 6 months, whatever it takes for you to sleep at night, knowing that if you run a business, maybe you have peaky kind of income, you might want 6 months. If you're in a job with a regular salary, you might be happy with 2 or 3 months. But cash reserves just to keep you going. I'd also put really well diversified investment funds here. If you're in the stock markets around the world, you've got really global diversification, that sort of thing would sit there. So these are long-term kind of buy and hold things that will be stores of value. Maybe you pass them on to your kids at some point as well in the future. So that's in your bedrock layer.
Would you put anything like diamonds or gems in there?
Yeah, possibly. Anything that's, you could even argue things like classic cars could go in there. Anything where essentially there's some rarity factor, and it's going to go up with inflation over time. It's going to protect you. It's going to hold its value. So those kind of assets definitely belong in that bedrock layer.
Okay, so we're moving up to this layer. What's this one called?
This is a bit more self-explanatory. This is the passive income layer, because the thing about these kind of assets is you can't really live off them. You can't pay the mortgage with them. You can't buy the food at Sainsbury's with them. So you need income. And obviously, as we've talked about in the past, financial freedom is all about when your income, your passive income, equals or exceeds your monthly outgoings. That's when you're financially free. So we're looking here at all kinds of assets that would generate. Now, the most obvious one, particularly for this audience, is property. So buy-to-let property I would put in there, though I would kind of smile when I see that word there with buy-to-let, because most of the landlords I speak to say, oh, yes, I've got passive income. I've got 10 buy-to-lets. And I say, okay, and how many hours a week do you spend working on them? Oh, about 15 or 20. Ah, that's what you call passive income. Right, okay. I put my money into things like care homes and hotels and stuff like that, where I buy the asset and then I lease it back to the operator. They do all the work, and I just get the money in my bank account. So that's what I call passive. So commercial property is a great one in this space. Maybe some dividend-producing shares. At the moment, the FTSE on average is producing about a 5% dividend, which is a lot more than you get in the bank. And I would, again, with tongue firmly in cheek, I would put, bank and building society accounts here, because they do pay interest, however pathetic it may be. But anything here in this area is very much designed to generate passive income. And I think if you can look at, one of the things I tell people to monitor and measure on a regular basis is, if you stopped work tomorrow, what would your passive income be over the next 12 months? And suddenly people are like, ooh, don't know, And if you start a little spreadsheet of the assets you've got and the passive income they're generating, that's a really powerful thing to watch and monitor and measure. Because a lot of property investors are still thinking of the capital gains, and you can't eat capital gains. So what's the income? Is it cash flow positive? Is it increasing? What have I done this month or this quarter to increase my passive income? That's a really good question to ask yourself. So all those kind of assets live in your passive income layer.
I get that, and also that kind of ties back to what we were talking about in yesterday's video, where you kind of start to turbocharge your income engine. That's kind of happening in this section here, isn't it?
Yeah, well, what you've got your income engine is effectively putting new money into every layer of your wealth pyramid.
Got you, okay.
So you can decide what percentage you do that in, but if you've got your job and your business and your motorhome that you're hiring out or whatever, your cat's appearing on TV, that's all generating money that can then be fed into whatever layer you think is appropriate here. So the passive income layer, yes, those assets are generating money. I'll tell you in a minute what we do with that other than live on it. And then the next one, and this is a slightly more, I suppose, a sophisticated development for most people, is looking at global diversification. It's really important, I think, to think of yourself as a citizen of the world these days. Yeah. The world is a small place. We all jump on aeroplanes to go everywhere, don't we? Much more so than perhaps when I was growing up, and traveling abroad was an exciting new thing. Today, we just think nothing of it. The same should be true of your investment portfolio. Most people have far too big a home bias, so they've only got property in the UK, they've only got stocks and shares in the FTSE. You've got to start thinking about, what about exposure to other countries, other currencies, other kinds of assets? So here I'd say, what have you got in the way of overseas property? What have you got in the way of overseas bank accounts? Can your business become something that could run from overseas? These days of broadband, we talked about how you can have a business to increase your income engine. Does it have to be in this country? Could it be in another country? Yep. I know people who, historically, we started in the French property sector, and I know people who made a lot of money from French property, not because it's gone up in euros, but because the pound weakened so much against the euro. They sold it 5 years later at the same price they paid for it, but they ended up with a 30% profit just on the currency movements. Yep. So once you start owning assets in multiple countries, you can play those games, and you can time it to fit however the currency movements go. None of us can predict what they are, but if you've got assets in multiple countries, you can do that.
Yep.
So, start thinking about global diversification. And, we've talked about some of the political developments in this country. What if we went back to the 95% tax we had in the 1960s? Are you happy to pay that? Or would you rather have maybe somewhere else you could go with a second residency in another country? So again, as you get more sophisticated, as you develop more assets, start asking yourself this question about to what extent am I really globally diversified?
Yep.
Okay. Then the final level of the pyramid is what I call the high velocity layer. And the purpose of this one is to make some of your money work a bit harder. So this is where you're going to get into some areas that are, things like private equity, there's some bonds and loan notes. Some of these you have to qualify under the FCA rules as a high net worth or sophisticated investor. So for example, high net worth means either that you earn 100,000 a year or that you have 250,000 of investable assets. Well, somebody with a buy-to-let portfolio will probably have that much equity across the whole of their property portfolio. So that could make them qualify as high net worth, and it would open up some of these investments to them. So typically I'm looking here for a sort of a 1 to 3 year time scale, and anything from 10, 12, 15% a year returns with a decent level of security. And so that kind of makes the money work a bit harder than it does further down the pyramid. And what we do is what I call the wealth trickle down, which is to say you take your returns from the higher layers and you move them down the pyramid like this, so that your returns from up here, let's say you buy some assets abroad, your returns from your overseas rental property, maybe you buy something in the UK, your returns from that, maybe you buy some gold or some art or some cash. So by trickling that down there and by putting new money in from the income engine here, what you're actually doing is organically growing this pyramid week to week, year to year. So, once you do this, you can say, okay, what we do in our one-to-one sessions is we create this for you in real time. So we actually say, okay, tell us about the assets you've got. Let's see where they fit on this pyramid. And then let's see where the gaps are that you need to work on over the next few years. So it gives you structure, it gives you a plan, it identifies gaps. Perhaps you're all here and you've got nothing here and nothing here, So it gives us a bit of clarity and a bit of visibility for the future. So that's the purpose of the wealth pyramid.
I think it's absolutely fantastic. And I think what's interesting, Graham, is over the past week, I guess we've been on a journey kind of building up this pyramid. We started at the bottom on day one, and then we talked about education and building your income engine. And really, we've been moving up through the pyramid, becoming more sophisticated and as we've grown as investors and business people. And you mentioned it in this category here about your passive income. Was there anything you wanted else to say about that?
Well, really, that's ultimately the most important layer in a sense from a financial freedom perspective, because once you've got your passive income up to a level where you're covering your costs, then you've got lots more choices. Choices of when you work, if you work, who you work with, and so on. I think generally what you're going to do is you're going to have to buy assets to generate this income. So this can be the more capital intensive layer. Obviously with buy to let, I know you're leveraging and all the rest of it, but once you save some money up, you buy the asset and then it can throw off the passive income. Typically these could be for 5, 10, 15 years. So we have people who use these to cover things like school fees or university fees. We have other people who use it to cut down on their working hours. So they might say, actually, if I have a couple of care home units that are giving me 14 or 15,000 a year, I could go down to a 4-day week. So I can change my lifestyle because I've got the passive income from the assets, So remember we talked about designing the life you want and funding it from your portfolio in your wealth pyramid like this. So what you've got here is effectively the sort of middle part. You've got the income engine feeding into it, and then tomorrow we're going to talk about how you can wrap a layer of protection around this with what I call a financial fortress. And those three elements give you this route, this roadmap to financial freedom.
Well, thank you so much for drawing that out for us. I'm sure you'll agree that that's a really effective way to look at this, get some structure to what you're doing, as you said, see where you're missing out on certain aspects of the wealth pyramid. I think that's really, really interesting, Graham, and everybody, I think, should actually go through this exercise. It would be really valuable to them to do so. And maybe we'll put something on the thread about, I don't know if you've got any little drawings or any little exercises where people can actually do this exercise.
Well, I've recorded a webinar about this, so perhaps we
perfect.
could put the link to the webinar on there. Cause
We'll put the link there.
I always know the session's gone well when they get their cameras out at the end and start photographing it before they leave. You know, that's the idea. So that's what we're trying to achieve.
Well, that's wonderful. So please join us tomorrow for the final day of our Investment Fundamentals Week, which Graham has been co-hosting with me. And as Graham said, tomorrow we're actually going to look at how we can put a protection bubble around our wealth pyramid, how we can protect the wealth that we've created through all this effort, this education, this income generating engine. And Graham's going to talk a little bit about his life now, that he's put everything in place through these processes. So hope you're enjoying the content so far. If you're watching on YouTube, I do invite you to click our subscriber button and notifications. And also, as always, our actual discussions and our members are hosted at propertytribes.com. So you need to jump across there from YouTube if you want to join our thriving landlord and property investor community. And as always, thanks for Graham. You'll see us both tomorrow.